And which data and indicators would you need to see change before you change your mind on this recession call?
Yeah, I think seeing an uptick in initial jobless claims
Hmm.
that have been so very subdued would be important. Seeing challenger job losses announcements, so an uptick in a number of layoff announcements would be probably very important. At the same time is that I think everybody would wake up if we had a negative non-farm payroll print.
Hmm.
There's a big debate as to whether that would be taken as good for the market, meaning weak job market, the Fed's going to cut,
Hmm.
everything's awesome for risk assets, or if it would be taken as bad for the market. We think it's bad news is bad news in 2024, only because if you look at where equity EPS estimates are, it's 10% for 24 and another 11% for 2025. Those don't contemplate any kind of recession.
Cameron Dawson joins us for the first time on the show. She is the Chief Investment Officer at NewEdge Wealth. Prior to NewEdge, she served on a number of senior positions at firms such as Bank of America. On the buy side, Cameron has a very interesting perspective for her outlook for 2024. We'll be covering her outlook for stocks, bonds, alternative asset classes, and wealth preservation strategies. First, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%, as well as unique tax benefits. If you're over 18, you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to get started. Cameron, welcome to the show. Good to see you.
Thank you so much for having me.
You are a fund manager at NewEdge. Tell us a little bit about your work currently, the areas of focus, and then we'll get into some of the more nuanced topics for today.
Yeah, so NewEdge Wealth is a private wealth manager focused on high net worth, ultra high net worth investors. And as the CIO, I oversee our investment platform and help set investment direction. We invest across the asset allocation spectrum. What that means is that equities, fixed income, but also a lot within alternative investments, building custom portfolios and strategies for our clients, which requires looking at the entirety of the world, entirety of the investment universe, pretty much everything under the sun in order to find the best opportunities for new investments for our clients.
And your clients, what are their top concerns from an investment perspective that they've been communicating to you?
Yeah, it depends on who you speak to. There's some people who look at a year like 2023 and say, gosh, I missed it. What do I do now? How do I invest
Don't
at a
miss it
cash?
again.
Yeah, how do I invest cash that's
Yeah.
sitting on the sidelines that's been earning a fair return, but where am I in my allocation versus where I'd really like to be? We do a lot of work in wealth strategy of setting or determining what an ideal allocation should be in the long run and putting clients on paths that regardless of what the market is doing and regardless of what the emotion or the narrative is, that we have a plan to get to that path. And a lot of that plan comes from understanding or knowing what you'll do in times of weakness. So usually when markets are weak or soft, what ends up happening is that you get arrested development, you want to make no decision at all. But if you have a plan in place, knowing long before in advance a 10, 20, 30% correction, what would I do if that happens? That can be a really powerful thing. So I think clients are looking for opportunities. They're concerned about volatility, about where we are in the cycle, but also not wanting to sit on the sidelines. So it's a pretty thin, small needle to thread.
Are you concerned about volatility? The S&P 500 has run up to new all-time highs briefly in 2023. Some people are calling for a correction in the first quarter of this year, precisely because of how far we've already run up, hence the volatility. Is that a concern for you?
Yeah, I think that we shouldn't become complacent. Just because the market surged higher, it doesn't mean that it will continue to go up with very low volatility. It is perfectly normal to have corrections, mostly when you get into overbought territory. So if we're looking at technicals, one of the things that we watch are things like RSIs, relative strength indices, a bunch of other momentum indicators, MACDs. What you can see is that as the market is pressing up against the high that it hit at the end of December, you've seen a little bit of deterioration in momentum. So the way to measure this is you say the RSI is not also hitting a high. This is not a death knell for a rally, meaning that if you have this RSI divergence, the rally's over and you're going to have some deep protracted correction. Instead, it's just to say it's a sign that maybe we're in for a little bit of digestion. And I think that the starting point of having had such a big run up is so very different than the start of 2023, when markets were very weak to end the year, positioning was very light, sentiment was washed out, expectations were low. You kind of flip that on its head when you start 2024. You've seen a lot of inflows into equities, mostly into tech and growth. You've also seen positioning by different metrics, institutional positioning flip to being very long. Sentiment is also very, very bullish. And so we have a phrase, the only thing to fear is greed itself, which is just to say, when you get to the point where positioning is crowded and it's consensus that everything is awesome, you have to be very vigilant about expecting what could surprise to the downside. It doesn't mean reduce positions. It just means don't get complacent.
Momentum, though, what do you think momentum is currently? Upside or downside?
Well, momentum, I think that there is a chance for a 5 to 7% pullback in the short term.
Sure.
But that's all very normal, very run of the mill, nothing to run for the hills, just because we have seen a little bit of that momentum divergence. We've also seen things like high beta start to underperform a bit. So that's a really good indicator. When the most volatile, most risk-on parts of the market are outperforming, it's a sign that risk appetite is high. And what you're seeing is people adding risk to portfolios. But when that high beta starts to underperform, it's a good sign at the margin that you're starting to see people pull back a little bit of risk in portfolios. So again, short and shallow, not necessarily deep and protracted, would be the call for any kind of digestion right now.
Well, give us your investment thesis. Sorry, please continue.
Yeah, just one more point on momentum is that it can't be lost, and this really comes from an observation from Jeff DeGraff over at Renaissance Macro, who talks about momentous momentum. This idea is that you had this huge momentum surge at the end of 2023, a measure of 20-day highs crossed a very important threshold of about 70%. And in his work, what you see is that that typically has led to strong forward, above average 12-month forward returns, meaning that when you have people clamoring to get into the market buying everything, typically the market is returning better over the next 12 months, not worse. The caveat to that I would add is that usually you see that surge in 20-day highs coming out of major bear markets. Meaning that it would be coming out of times like 2008 or 2020, or even times like 2018. So we have to take it with a little bit of a grain of salt, because October of 2023 setup was a little bit different than the major bear market lows of the great financial crisis, for example.
Are you looking at the valuations multiples for the indices and determining whether or not the same kinds of returns can be applied to the following years? In other words, we've had a great year last year. Multiples have been stretched. Basically, can we see similar returns going forward?
It's such a good question, because it raises the question of how predictive are multiples to forward returns.
Sure.
And the answer to that is that they're not very predictive in a 1 year, but they're very predictive 2, 3, 5 years out. The correlation goes up to forward returns for valuations, meaning that there's much more direct relationship. So high valuations lead to poor forward returns in the medium term, but they don't necessarily lead to poor forward returns in the short term. And the reason for that is things like valuations and sentiment and positioning, those kind of stretched extremes, they can persist. So when I look at valuations today, they are extraordinarily stretched. 19.7 times on a forward basis for the next 12 months, 17.7 times on a 2-year forward basis. That's the highest level since the pandemic peak. And we can talk about why that pandemic era of valuations may not be the best comp to use for how high we should trade this market from a valuation perspective. So we see valuations as hitting a ceiling. The thing that would drive valuations higher from here would be incremental liquidity, meaning whether it's things like the Fed stopping to do QT, which is expected, or more importantly, probably liquidity from the Treasury. One of the things we think drove valuations to be so high in 2023 was the fact that these broad liquidity measures, looking at things more than just what the Fed balance sheet was doing, but including things such as what the Treasury is doing, funding with bills, looking at bank reserves, these were a tailwind for valuations in 2023. Our biggest question mark is that as the Fed or as the Treasury has to fund a $2 trillion deficit, bills are already at 22% of the outstanding government debt, which is above the threshold that TBAC, the Treasury Borrowing is something authority commission, something it's called TBAC.
Okay.
That they suggest about a 20% threshold. So can Yellen continue to do as much bill funding? This seems esoteric, but the reality is it's going to impact valuations. So 19.7 times, it's a very full multiple. And I would say that the notion that the equal weight index is cheap, it's about average now. It was cheap in October, but then it had a 20% multiple re-rating over the course of the fourth quarter.
Yeah.
So I think that there are pockets that are inexpensive. You have to be very selective. Some things are inexpensive for a darn good reason, which just means that selectivity is hyper important.
Yeah, on that note, I mean, I understand we have to be micro-oriented here in this market, but generally speaking, do you think the small and mid caps are better or more cheaply valued than the large caps, considering that the Russell 2000 has more or less been trading range bound for the last 24 months?
Yeah, they're cheap, but that probably falls into many of them being cheap for a reason.
Right.
So when we look at small caps, we like to look to the Russell 2000, but we also like to look at the S&P 600.
Okay.
It's a little bit larger size companies, but what you have is more profitable companies in there. So the valuations tend to actually be a bit more accurate. It's hard to value a company that doesn't have any profit on a PE multiple, for example. And what you can see with that S&P 600 is that it trades at about a 22% discount to the S&P 500. That's near a record of the last 10 years, 10, 15 years. The challenge is that that discount versus the S&P 500 has been progressively getting larger and larger since the great financial crisis. So it started prior to the GFC at a 40% premium, and it's now at a 22% discount. When it's that steady and derating year after year, no matter what the Fed is doing, interest rates are moving lower that entire time, would tell you that there's something structurally not in favor of small caps versus large caps. So I would say is that they're cheap enough to see a very quick re-rating if something were to be a tailwind where people start to say, I have a greater appetite for small caps. But at the same time, that appetite actually has materialized. If you look at small cap ETF flows, so including things like IWJ is one of them, I took the 3 largest small cap ETFs and tracked the 3-month rolling flows over the past couple of years. And what you can see is that in that fourth quarter rally we had for small caps, there were nearly as much inflows into small caps as 2020 and 2021. In the periods when the largest weights in the small cap index were a lot of the meme stocks that were seeing huge inflows. So I don't know if it's as under-owned and under-loved as as consensus might say. There are amazing opportunities within small caps where there's likely mispriced assets. We're finding them in some of our portfolios where we're saying, this is a great company, it's cheaply valued. However, I think buying the index probably isn't enough within small caps.
Okay. Well, let's talk about your thesis for 2024. 2 of the major themes that people have been talking about is the possibility of a recession or not. We'll discuss that. And number 2, the possibility of lower interest rates. And so let's talk about your economic outlook. I'll just get to it. Are we going to get a recession this year?
So our call is no recession in the first half of 2024. We reserve the right to update that outlook in the second half of 2024, but we think that the probability of a recession in 25 is more likely than a recession in the second half of 2024. The thing we'd note is that we think we're in an environment where the data can change really quickly. And what we see right now is a lot of health within the labor market. And those broad labor statistics do not look like they are deteriorating in a material way. Jobless claims this week came out still very healthy. We have unemployment rate that still sits near a 50-year low. I get that that is a lagging indicator. Non-farm payrolls are healthy. However, we are starting to see some cracks. Quits rate is now below the 2019 peak. It's fallen quite a bit from the pandemic peak. These are the rates of people willing to quit their job. It's a reflection of how confident somebody is that they can get a new job or a better job.
Maybe
So when they
bosses just became nicer in the second half of 2023.
What is it? In bosses.
Maybe managers and bosses just became nicer in the second half of 2023. I'm making a joke.
Exactly.
Anyway, continue. Yeah, you're right.
Big raises or something like that.
Right.
Well, but it's a reflection of just how tight the labor market is. Now, I'd say is that, yes, it's declined, but it's not at recessionary levels to say, oh, it's not falling as much as it did back, of course, during COVID or during the great financial crisis. The other one to watch is temporary jobs. That has returned, that has fallen. It has typically been considered a leading indicator of broader job market, but it's not fallen to the extent yet that would say recession warning.
Yeah.
So all of these things fall under the camp of normalization, not necessarily weakness. I think the theme for 24 is, does normalization continue and turn into weakness?
Right.
And if it does, that's when, the reserve the right to update our forecast. We might say, hey, a second half recession is more likely. But as of right now, we say, okay, headline data, it looks pretty strong. There's some areas that could recover. And let's not forget that $2 trillion deficit sure does a lot to help stabilize growth, given the fact that you're still having a pretty big fiscal tailwind.
And which data and indicators would you need to see change before you change your mind on this recession call?
Yeah, I think seeing an uptick in initial jobless claims that have been so very subdued would be important. Seeing challenger job losses announcements, so an uptick in a number of layoff announcements would be probably very important. At the same time is that I think everybody would wake up if we had a negative non-farm payroll print. There's a big debate as to whether that would be taken as good for the market, meaning weak job market, the Fed's going to cut, everything's awesome for risk assets, or if it would be taken as bad for the market. We think it's bad news is bad news in 2024, only because if you look at where equity EPS estimates are, it's 10% for 24 and another 11% for 2025. Those don't contemplate any kind of recession. So if you're getting negative non-farm payroll prints, and you're already pricing in the Fed's going to be easy at that 19.7 times forward earnings, there's probably more risk to the downside in a risk-off move and the fact that I have to cut my EPS estimates. So our view is that if we have that deterioration in data, bad news is bad news. Fed may be easing, but they're going to be easing because they need to, not because they want to.
Let's talk about that. So let's establish your assumptions for the Federal Reserve and their monetary policy this year. How many cuts are you expecting?
We're expecting 3, and that's assuming we don't have any kind of recession. We think it looks more like a tweak lower in policy where they do not want to signal an outright easing. Mostly if we remain in this state where inflation, yes, it's moderating, remains somewhat above their trend in some of those sticky measures. The labor market remains tight. The fact that if you don't see a big uptick in unemployment, the Fed itself has a forecast of 4.1% unemployment for 2024. So put that into context of saying they're comfortable with that degree of easing. For us to get to 6.5, we think that you'd have to see a lot more labor market easing and a lot weaker data.
3 cuts is only assuming a 25 basis point cut each time is only 75 basis points. It's not significant considering we're already at 5.5. Would that significantly change your asset allocation strategy at all?
Really, I mean, at the margin, it makes cash less attractive. But we've been finding opportunities to extend duration all through last fall as rates were going up and surging higher. So finding more opportunities within fixed income. But that actually is a really good point about changing the asset allocation with a 75 basis point change to the rate hikes, which is that rates are still high. And it means that those that have to refinance their debt even with rates 75 basis points lower, are still going to be refinancing debt at a much higher price than they were when they issued the debt, say if they did it in 2020 and 2021. 2020, 2021, we had a great refinancing wave. We had a massive amount of issuance of new debt because yields were so low and markets were so open because the Fed was flooding markets with liquidity. A lot of that debt, mostly for high yield borrowers, starts to come due more in 2025, a little in 24, a lot more in 2025. So if rates stay somewhat high, they're not at their peak, but they're certainly well above where they were in 2020 and 2021. Those with weak balance sheets will face much higher borrowing costs. And I think that that's one of the reasons why we continue to have a quality bias in our investing and saying, yeah, the Fed might be tweaking rates lower. This is not YOLO, buy everything, buy junk, buy trash like you had in 2020. This is, hey, we're still late cycle and balance sheets still matter. So we're going to stick with high quality balance sheet names instead of dipping into trash that would benefit if the Fed were flooding the markets with liquidity like it did in 2020.
I'm just basing my next question on your tone here. I'm guessing you didn't buy GameStop in 2020, 2021.
No,
The Reddit.
I had fun staying poor.
Well, you didn't get poor losing your money, so that's also the other side of the coin. Generally, then, which assets or not assets? We'll get to asset classes later, but which specific sectors do you prefer, given your quality bias?
Yeah, so we in the Outlook, I published a chart that showed the tech sector, and tech is crowded. It had the most inflows of any sector in 2023 by a margin. Most other sectors had outflows. So tech is a crowded trade. It's also expensive. It's one turn below its 2021 peak in valuation. However, it's in an uptrend, and the chart showed the picture of the capybara, the animal that is rolling in the mud, and it's moisturized in my lane.
I haven't seen this one. Is this a meme?
It's a meme, and so we think tech is kind of like the capybara. He's moisturized in his lane, and he's thriving. It's in an uptrend. We don't want to fight the uptrend. So we've had an overweight to tech. We're going to keep the overweight to tech, but we are not ignoring it's crowded, it's expensive. And when it breaks and turns in the other direction, you have a year like 2022 where that's painful. We like healthcare as kind of the opposite side of that. It was very beaten up over the course of 2023, partially because it had some of the worst earnings in 23, down 30% last year. A lot of that is just because of normalization post-COVID and pharma struggling a great deal, biotech struggling. But that flips to positive. In 2024, you have some of the best earnings growth projected for healthcare, trading at a reasonable valuation, and it's under-owned when we look at ETF flows.
This generally speaking, when it comes to investing, whenever the interest rate decreases, you're looking at a lower cost of capital for companies. However, lower interest rates also usually mean higher bond prices. So how do you make the decision to allocate more or less into equities versus bonds when rates go down, Cameron?
Yeah, it has to start with the individual plan for the investor, because what we're trying to solve for is not just total return, but also you have to balance things like liquidity needs. And that's where fixed income can be a very important source of providing liquidity for investors if they think that they might need a certain portion of their portfolio at a time to buy a house, for example. And so when we structure portfolios, we're keeping in mind that fixed income plays the role of generating income, but also being a great source of, if you need principal liquidity, that you can tap into that. So we have to keep that in mind when we're making any allocation changes. At the same time, is that if now we can earn a return that meets our return target for the portfolio by taking less risk, in some cases, it might be prudent to do so, meaning that as bond yields are now higher, we've been able to potentially, instead of allocating incremental dollars to equity, allocating incremental dollars to fixed income in order to reduce overall portfolio volatility. So the thing to keep in mind with that, though, is that if you're a taxable investor, like we all are, is that if you're making reallocation, you have to think about the tax impact as you go through that allocation change. So overall, it's an individual decision, and one that we go in with each client to make sure that we're calibrating right to their plan and to where their goals are.
I'm curious as to whether or not any of your clients, your high net worth clients, have inquired about Bitcoin and cryptos overall, given the recent approval of the Bitcoin ETF.
Yeah, certainly we've seen an increase in inquiry about it, and people wondering if this is a good, efficient way in order to get exposure to the asset class. And so we're doing a lot of due diligence about the different providers to see for those that would like to get exposure, is the best, safest way, most cost-effective way in order to do so. But the inquiries certainly have kicked up.
Well, I would guess that a lot of your clients are interested in wealth preservation as a general strategy, not just growth. How would you create or curate a strategy that really just preserves your wealth instead of just aggressively growing with high risk?
Yeah, I mean, first it's striking that balance of between growth and preservation, and having downside
Hmm.
preservation. And I think bonds, when people start tossing out saying, hey, 60/40 is dead and bonds don't play the role of wealth preservation like they used to, that's not necessarily true, meaning that the reason why bonds struggled so much in a year like 2022 is, of course, because you were mispricing from repricing from being highly intervention through the course of 2020 and 2021, suppressing interest rates at the same time with a high inflation spike, which of course typically doesn't bode well for bonds.
Mhm.
But if we do have a recession, we have a classic flight to safety, bonds can perform far better, be a far better source of portfolio protection. A lot of the preservation of wealth also comes from diversification and realizing that not everything's going to cycle at different times in the economic cycle. And some of that diversification comes in the alternative side of the business. We're willing to take risk there, but realizing that you can have opportunities for commodities and real estate, which have different drivers. They are correlated to markets in some ways, but certainly not a one-for-one in what you're seeing within equities. So we typically build highly diversified portfolios, and you will put more risk off downside protection portfolios for those assets and portfolios for those that are concerned with more wealth preservation.
And alternative assets, where do they fit in your strategy or portfolios?
They're incredibly important, mostly for investors who don't have immediate liquidity
Hmm.
needs. If you can give up on the liquidity in order to enhance long-term returns, they can be very attractive. At the same time, is that there are more structural issues or structural imbalances within a lot of private markets that benefit investors. We'd say the thing is that you have to do an incredible amount of due diligence on the funds that you work with, on the managers that you work with. In long-term investment strategies, if you're locked up for 7-8 years, you better know who you're investing with. So we have a really robust team in order to be able to identify the investments that we want. And we are diversified from everything from private equity, within private equity, GP stakes, secondaries, lower middle market, traditional buyout, all the way to venture and early stage venture. We do things in private credit, private real estate, and then legal funds. Super diversified in order to be able to to get access to different pockets of capital that are highly unique.
Okay. We'll close off on risks. I know nobody can predict a black swan because that's a definition of a black swan. But if you were to go as far as to say tail risk events that may throw off your, I would say risk on bias, what would you be looking out for? What would you have your finger on the pulse on?
Yeah, there's a few of them. I mean, I think we can't ignore geopolitical risk
Sure.
in 2024, of course. I know that's a blanket statement, but I think the dollar is one that's really important to watch. A major dollar bear market could throw an interesting wrench in the Fed's plan to ease policy, meaning that if you have sharp dollar weakness, that could contribute to oil price strength. One of the key reasons why inflation has moderated so much is because oil prices went from being up 75% on a year-over-year basis in 2022 to being down 45% on a year-over-year basis in 2023. Oil prices go back up, headline CPI reaccelerates, all this pricing for a much easier Fed, all this hope that we're going to have a liquidity tailwind behind us starts to go away. And so I think that investors shouldn't be complacent about that. That seems like a very known risk, hardly one that's black swan. Obviously, broader geopolitical issues, things what happening in Taiwan and China is something that, of course, would roil markets in a very serious way. And then I think structurally, we've seen so much shift to private markets and shadow banking and certain credit, as banks have had to exit businesses. We're always on the lookout for the next credit issue. Right now, we assess the backdrop of balance sheets to be healthy for consumers and corporations, but there are pockets of stress and weakness. We think smaller businesses that have more floating rate debt and have more debt that might be coming due over the coming years likely are an area to watch. Small businesses are the traditional backbone of the U.S. economy, so we don't want to be complacent that higher rates will eventually bite. It's just been delayed. I think one of the things, though, probably the most surprising stat for people is that according to Bureau of Economic Analysis data, net interest expense, so the interest that you earn on cash minus the interest that you pay, or opposite way around, what you pay minus what you earn, has actually fallen precipitously in 2023, meaning that overall corporates are earning more on their cash than they're paying more on their interest. That's never happened in a Fed tightening cycle, and that's a function of QE being so distortive, allowing people to be able to term out debt at very, very low interest rates. That overhang lasts for some time, but we often say you sow the seeds of the next crisis when you think everything is great. And so we always are watching for areas of where you could see balance sheet issues, because balance sheet recessions are deep and protracted. Inflationary recessions are typically short and shallow. And so not being complacent on the risks around balance sheets, I think, will be very important. Probably not a 2024 issue, maybe more like 2025 or 6.
I want to close off on banks, actually. How do banks usually perform during a tightening cycle or rate reduction cycle?
That's a great question, because my thinking is that it's not been consistent. We think about banks from a yield curve perspective. They typically struggle in times when the yield curve is inverted, meaning that they don't earn as much of a net income margin on their lending activity. This cycle has been a little bit different because the biggest banks that we follow have been able to keep the yield that they pay on their deposits so very low because of the disruption within regional banks, because of their size, because of their market power, which led to massive net interest income over this cycle. And this current earnings season has actually guided to, even though the yield curve is less inverted, companies saying, hey, we're going to earn less net interest income going forward. I think banks are a cyclical asset. It's always good to remember banks are cyclical. And so they tend to do better when the economy is doing better, and tend to underperform when there are signs of distress because of credit risk. But banks are also, as a cyclical asset, becoming more like utilities in a way, because the largest banks are being so heavily regulated. So we saw a structural step change post the great financial crisis in the valuation of banks because of the restrictions on them, on the different business activities that they could do. I wouldn't question, if mostly if Basel Endgame gets enacted, that you could see another structural step change lower in valuations for banks because of regulatory oversight, which just has the effect of pushing more lending activity into shadow banks anyway, which I would which I would argue would be more structurally unsound, but that's a completely separate discussion.
We'll save that for another time, Cameron. Before we close off, give us some career advice. I mean, you've broken into the industry at a relatively young age. You've climbed your ladder up very quickly, rather quickly. You've held senior positions at the Bank of America before joining NewEdge, for example. So if for the younger audience members watching this right now who want to break into the buy side, they're studying finance in college or economics or anything else, what should they do to prepare for themselves or prepare themselves for this industry?
Well, I love doing the CFA. I know it's a lot. I know it's a huge undertaking, but I use what I learned through that process on a daily basis. But outside of that practical advice, the biggest piece of advice I can give is be nice to everybody. Be nice to everybody that you interact with in the industry. I have had doors open to me and one of the most important ones is salespeople. Your sales coverage that covers you, that they know everybody,
Right.
and they have been huge helps to me at different points in my career. And your life is long and your career is long. Be nice to everybody.
Well, I can just tell you right now, I mean, I studied finance. Not everybody in my finance class sounded or knew as much as you do. So clearly you did a vast amount of self-studying. What was your process in just teaching yourself finance and economics and learning the industry after school?
Yeah, I mean, I think a lot of it comes back to
Besides the
this.
CFA, yeah.
Yeah, I mean, like, believe I don't, what is it, 400 hours or something like that they
Right.
feel it, 600 hours. I think felt like I did 4,000 hours.
Yeah.
It helps that I love this. I find this to be the most fascinating industry in the world, and that you have to learn and learn new things every day. Think about it, all of the things that have happened over the past couple of years, us as financial market watchers, we're having to wise up to saying, oh, wow, this now matters. The fact understanding reverse repo and bank reserves, the interaction with T-bills and all these things that maybe we didn't think about as much 5-6 years ago, but now we really have to think a lot about. It's fun because it's ever changing. And I think that reading a lot and reading more books, that's the biggest thing. I think a study of history, people will say, oh, you're young, you've not seen it before, and that's true. If I didn't live through the inflationary period of the 1970s, but if I can read a lot of books about it and have historical context, and have conversations with people who've lived through it as well, I think that it can be helpful. So read books,
Right.
lots of articles. Books take a long time to write. There's a lot of thought that goes into them. And I think that it's a good practice to try to reduce the short form and get into the long form. It's a little bit counter to what we're used to on a daily basis.
A final question. I like to ask this to the managers. One trade that you've made a mistake on, and looking back, what you would have done differently?
Well, I remember the one that's coming like straight to my mind.
Yeah.
It was painful, only
Right.
because I remember one of the first picks that I had was UPS,
Okay.
UPS as an industrials analyst, and got into the analyst day, and I was like, oh, this is great. They have fantastic margins, and look at the returns on invested capital, and they're going to turn it around, and all this stuff, and everything's going to be great. And the stock just did nothing for years. And so every time I saw one of those darn brown trucks on the street, and they're everywhere, my gut would sink, and I would just be like, oh, I'm an idiot. I'm an absolute idiot. And part of it is because I believed management. I mean, it was an early lesson to say, like, oh, just because they say that they're going to do it doesn't mean that they're actually going to do it. And it ended up working. It just took an extra 2 or 3 years, but at least we clipped the coupon while
I'm guessing you don't use UPS now for your own mail, but just to guess.
No, I'm better.
Where can we learn about you and your work, Cameron?
Yeah, I'm on Twitter or X at Cameron Dawson. You can go to the NewEdge Wealth website. We publish weekly. Just released the Outlook. That's on there as well. I'm also on LinkedIn, so you can find me there.
Perfect. We'll put the links down below. Thanks very much for your time today, Cameron.
Thank you for having me.
Thank you for watching. Don't forget to follow Cameron. The links down below, and subscribe to this channel.